If you're a military veteran or active duty and you're thinking about using your VA home loan benefit, there is one thing that can quietly make or break your loan approval, and it's your income. Not just how much you make, but how the income looks through the eyes of a VA underwriter. And behind every VA approval or denial, there is somebody reading your pay stubs, W-2s, tax returns, and your job history line by line using the VA Lender's Handbook. And in this video, I'm going to show you exactly how the VA underwriters look at your income so that you can prepare and position yourself to get approved with confidence. I'm going to cover what VA calls effective income and what underwriters are actually trying to figure out, how they look at your job history and stability, how they treat your spouse's income, and how new jobs or job changes, overtime, second jobs, commissions, and self-employment are analyzed. And by the end, you'll know how to present your income the way a VA underwriter wants to see it so you can avoid surprises and move faster toward closing and getting into your home. Hi, I'm Alex Ramirez. I help veterans and active duty service members, Guard and Reserve, and surviving spouses navigate the VA loan with clear, simple guidance. And if you like straight to the point VA information, hit that like, subscribe, and tap that bell so you don't miss any of my videos. In the future, I do weekly updates. All right, first, let's go over what underwriters are actually doing. The VA handbook says that the underwriter has one main objective when it comes to income. Their job is to identify and verify income that can safely cover the mortgage payment, other housing expenses, your debts and obligations, and your family living expenses. So they are not only asking, can you make the payment this month? They're also asking, does this income look stable and safe for long term? VA uses a term called effective income. Income is considered effective when it's verifiable, stable, and reliable, expected to continue for the foreseeable future. And the handbook also says income analysis is not an exact science. That means the underwriter is supposed to use good judgment and flexibility and look at each loan on a case-by-case basis. No loan's going to be the same. And they also decide whether your income is stable and reliable. The underwriter looks at your past employment record, your training and education, your qualifications for your current position, the type of work you do. Only verified income can be used in your qualification. If it cannot be documented, it does not count. So when you hear a loan officer ask for extra pay stubs, W-2, or tax returns, this is why. We are building the story of a stable and reliable income to get an approval on your loan. Now let's talk about your spouse's income and how the Equal Credit Opportunity Act comes into play. If your spouse is going to be on the loan and contractually obligated, their income is treated just like yours. Same documentation, same rules. But lenders are not allowed to dig into the spouse's income unless one of these is true. Your spouse will be on the loan. You're using your spouse's income to qualify. You're relying on support payments from a spouse or former spouse. You live in a community property state. In community property states, the lender can request information about a spouse even if they are not on the loan, because the law treats many debts as part of the marital community. And here's an important detail. The non-purchasing spouse credit history does not have to be considered if they're not on the loan, but their liabilities like car payments or credit cards or personal loans do have to be considered because they impact the overall household budget. Under Equal Credit Opportunity Act, your income cannot be discounted or ignored because of their sex, marital status, age, race, or any other of the protected categories. When it comes to child support, alimony, or maintenance, you must always be told that you do not have to disclose that income. And if you want that income to be used to help you qualify, it has to be disclosed and verified, but it's always by your choice. So let's go over income from a non-military employment. Okay, let me move to your civilian job. So income from a non-military employment. The VA guideline here is really simple. Verify a minimum of 2 years of employment history. So if you've been in your current job for 2 years or more, that is a strong indicator of stability. If you've been with your current employer less than 2 years, the underwriter will verify your prior employment so that together you have 2 years of history, or document why 2 full years could not be verified. And what they do, they compare different sources like verification of employment forms, pay stubs, W-2s, tax returns. Everything is checked for consistency. Any big differences that could affect your ability to qualify have to be explained. Employment verification services. Lenders can also use employment verification services to get all of this cleared up. They typically will reach out to the work number. And this is what the work number will give. It'll give the employer name and address, your name, job title, and social security number to verify it's the right person, your employment status and start date, your salary and pay frequency. So let's say you get overtime or bonuses, average hours per pay period, and your year-to-date income, including all the overtime, bonuses, commissions, any additional income that you receive. And when this is used, a separate pay stub may not always be required by the VA, but many lenders still like to see one. The lender cannot charge you a fee just to verify your employment. That's just part of doing the loan for the lender. So standard documentation. So standard verification usually looks like this: a verification of employment form or equivalent document, pay stubs covering the most 30 days with your year-to-date totals. And these documents must be recent, usually 120 days of closing or 180 days if it's a new construction home, but you want to provide your most recent, typically the most 30 days. For seasonal work, building trades, or climate-dependent jobs, the underwriter may also ask for a year-to-date earnings statement. Signed tax returns for the last 2 years, they might want to ask for that as well. And sometimes union documentation if you work through a union hall. Alternative documentation, sometimes a full verification of employment is not necessary. VA allows alternative documentation when your income clearly looks stable and reliable. And that can be pay stubs for at least the most recent 30 days with a year-to-date income, W-2 forms for the last 2 years, and a documented phone number to call and confirm your current employer with the company you work for. And if an employer will not verify by phone or something seems a little questionable, then the underwriter sticks with the standard full verification. So let's go over short job history and frequent job changes. Let me talk about 2 situations that scare people, but do not always kill the loan. So employed less than 12 months, that's not an issue. The guide says that employment for less than 12 months is generally not considered stable and reliable by default. But the underwriter is allowed to consider it stable if the facts support it. They look at whether your past employment, training, or education prepared you for this job. So if you went from a military mechanic to a civilian mechanic, or you just graduated nursing school and started a nursing position, that is a very strong link. In that case, income can usually be counted. If income from a job under 12 months is used, the underwriter must explain why on the VA loan analysis form. School actually works as verification as a job history because it's training you for the job you currently have. If the probability of continued employment is good, but not super strong, there is another option. The underwriter might use the income to offset short-term debts like 6 to 12 months instead of counting it full as income. So if you have a signed job offer that begins at or after closing, that can be considered as well. Even if you do not have a pay stub yet, the underwriter looks at all relevant data. And frequent job changes. So if you had a short time in a current job and a recent history of many jobs, that requires a little bit of extra attention. The underwriter will absolutely ask you, why did you have so many job changes? Or was it for more pay or advancement in the same related field? Or is it a pattern of hopping with no clear benefit? They're not gonna like that third option. Favorable consideration is given when you change jobs for career growth in the same line of work. If there is no clear improvement or you keep jumping across different fields, it is harder to consider that income stable. So if the income is used, the underwriter has to explain why, again, on the VA loan analysis form. So overtime, second jobs, and commissions, and also self-employment. Let's cover that. Now let me talk about extra income sources that can really help you qualify when they are documented correctly. So overtime, part-time jobs, second jobs, and bonuses. The VA says this type of income usually cannot be considered stable unless it has continued for at least 2 years and that it's consistent and there is a reasonable expectation that it will continue. And the underwriter will look at how long you've been working this extra job or earning overtime, and whether the hours and conditions make sense with your main job, and whether the pattern is solid or sporadic. And if the income does not meet the full standard to be included as effective income, but you have at least 12 months of history, it can still sometimes be used to offset short-term debts between 6 to 24 months. And that also must be explained on the loan analysis form. So let's cover commission income. So for commissions, the lender verify year-to-date commission income and how you are paid, such as a salary plus commission or straight commission, or are they draws? And also, how often are you paid? And your signed tax returns with all schedules for your previous 2 years. Commission income is generally considered stable when you have at least 2 years of it, so you need a history. Less than 2 years might work if you have related experience or training, but less than a year rarely qualifies. Those cases usually require a very in-depth development. So car loans and leases are not deducted from your income. They are treated as regular monthly debts. This is a little bit of a tip you need to know. And self-employment income. So for self-employment, the underwriter collects a current year-to-date profit and loss statement, the current balance sheet, signed personal tax returns with all schedules for the last 2 years, and also business tax returns are very important. So you're going to want to see the ownership and the breakdown, whoever owns the property, and if you file as a corporation or partnership. Income from self-employment is usually considered stable when you have at least 2 years of history. If it's less than 2 years, it could sometimes work if you had prior related employment or specialized training for that business. Less than a year is very rare and requires a lot of backup documentation and a lot of explanation. That's a lot harder to get that loan approved. And the underwriter is going to look at whether the business is producing enough income to meet your needs. And also whether if the income is steady, increasing, or declining. And if the income is declining, they have to decide if that is temporary or a real ongoing issue. Depreciation can often be added back to your income, but any true business losses must be considered and deducted. And on joint returns, business losses have to be counted even in a non-community property state. And if your income is not simple and straight salary and you have a lot of mix of commissions, overtime, bonuses, or self-employment, don't try to guess that all on your own. Reach out to me. My information is going to be right here on the screen. Send me a text, give me a call, or go to my description and schedule a discovery call, and we'll go everything in detail. The big takeaway here is that the VA is not trying to make your life hard. The guidelines are designed to make sure the income used to qualify you is real, stable, and likely to continue. And if you understand how underwriters think, you can prepare the right documents and tell the right story and remove a lot of the stress from the process. And if this video helped you, hit that like, subscribe, and share it with another military veteran who needs this information. And remember, be smart, be prepared, and let's get you home.